Keep me on time, please. I've tried to bring some notes so I can make sure that this is as concise but useful to you all as possible. And I think and hope that a lot of this information won't be viewed as new to you, just kind of seen through a different lens or packaged differently. As an investor, we focus on a lot of sustainability issues and themes that pertains to natural capital and biodiversity, climate change, technology innovation, human rights, and what we're here to talk about today, human capital. And so this matters for us and how we work with our investors across asset classes, focusing on companies across regions and sizes to really understand what are the differentiators in establishing best practices in areas of the business that really matter the most, but then also, seeking companies that are doing new and innovative things that could be new opportunities for investors to explore into the future. So when we think about human capital management, we think about it twofold. Today, I'm going to be going through what are the foundations set within a company in terms of their human capital management. How does that enable them to grow organically and to maintain an infrastructure that's rooted in people as a primary asset, in addition to maybe fixed physical assets. And then from there, find who the enablers are within the ecosystem of, let's say, processes, policies, procedures, a way of doing work that enable companies to do this well. So we'll go through a bit of that today. Great. So with a backdrop, how we think about the investment landscape, basically my team tries to think about what are some macroeconomic trends that matter within the themes that we look at. So when we think about human capital management, we want to understand how and why is this material to companies? What companies is this more material than to others? And then what are they doing about it? And so when we think about human capital management in this context, there are a lot of, I think, cyclical drivers that I'll be talking about as a baseline of thinking to then understand, what's the importance and materiality about this to companies themselves. So, on the left-hand chart that you see here, this demonstrates dependency ratio. Essentially, the higher the number, the more people there are in the economy who are essentially supported by each working individual. The higher the ratio, the fewer workers to retirees and school-age individuals there are. And so the higher the line, the harder it is to find workers. The chart on the right, on the other hand, reflects the slowing global population growth. Forecasts are predicting that essentially the global population growth will decline in 2028, around 2029. And then essentially these developments that we think about will have a huge impact on economic growth as part of inflation, in addition to inflation. And so the way we're thinking about this is that labor scarcity means that companies will not only be paying more for workers, but it also means that they'll have to invest in technology that allows them to be more productive. And that's something I'll talk about at the end as it relates to AI in the context of human capital management. So, as you see here, there's a variety of really structural and cyclical reasons that really emphasize the importance of analyzing human capital and human capital management today. But, if we just take a step back for a second, every single company pretty much has claimed that forever, people are their greatest assets, right? And all of the big investors that you might have heard of, Charlie Munger, Warren Buffett, when they think about and talk about the qualitative aspects of a company, they put human capital management at the top of that conversation. So, above all else, really what we're trying to really do in this human capital research work is really understanding that we've been developing information to introduce a quantitative lens to this and qualitative ways to use this kind of novel data for us to understand our analysis, to produce more analysis that have already been honed in by academic and HR circles, to be honest, and then really try to empower our analysis to understand these topics in a bit more detail in the investment context. So that's the background. I think to move forward a little bit, when we think about this in today's terms, one of the cyclical drivers that we've seen really affect people are the workforce as relates to millennials today. I'm a millennial. When a lot of millennials joined the workforce, it was after the financial crisis, right? And then in the context of what we're talking about today, there's been much more of an urge for that view of purpose within the workforce. And that's really being driven by the millennial group. And so what we really want to be able to understand in this context, how can businesses curate culture, that warm and fuzzy feeling that breeds people to be dedicated to that workforce, to either stay there, remain there, and get the most out of them, or to boomerang back in the context of what a lot of you are speaking about today. I think it's all very interconnected. Labor to a certain degree has some bargaining power today that has not been there in the past. And this is kind of what I'm talking about when bringing up millennials. And whether or not we're going into any kind of recession, the reality is, when we look forward today, the importance of the relationship between both employees and the workers is incredibly relevant, and it's important to understand the precedence of this in a company developing a business model. So that's really what we're coming at from an investment standpoint, and why we focus on this issue. There's kind of 5 systems for sustainable human capital development. And when we say sustainable, I'm asking me, when she hears sustainable, she thinks green. When we think about sustainable, we think about durability, right? And we think for many companies, the human capital management is at the center of that durability to continue to persist. And in the case that we're looking for as investors, have financial return and get shareholder benefits that come with it in a responsible manner. So when we think about human systems, we're thinking about the operating model in which they're working in. We're thinking about culture and inclusion, incentives and performance management, which is crucial, talent and learning, as well as innovation. So if we start with definitions, for us, human capital effectively refers to the capabilities, the networks, the relationships that are built up and that exist within an organization, right? So human capital itself is very rich in its own definition. On the other hand, human capital management, by definition, is the optimization of the management of that resource and the maximization of its potential and the value of that resource. And so whilst we've made a lot of progress in being able to introduce quantitative metrics to assess this kind of information, to improve or enrich the qualitative analysis that we can do, we have to sort of reflect on the reality that because of the complexities that are involved in human relationships, people relationships within the companies, their bosses, and so on, what we're doing here is helping ourselves ask better questions of the sources of value creation and the sustainability of those sources. But I mentioned, before that, this has been done in academic circles and in HR circles today. So we're trying to put our investment lens on it to evaluate companies on a fundamental sense. What we have effectively done in our research is try to think about this first from, principles about this point. If the management of culture, if the management of people, the incentivization of people, the performance management of people, is it material? Is it accretive to companies' financial returns? And if it is a material, if it has consequences or implications on the financial returns, we should see those outcomes in metrics that reflect the leverage that a company might generate on its total investment in people. So when we think about that investment in people in this context, those 5 or so human systems are really in between both the company's foundations, which is the natural and social capital within it, the company's purpose and the governance of the company, but the outcomes that are related to the foundation of the human systems are going to be things like financial capital returns, productivity gains, human capital quality jobs, in addition to some of that nature and social brand equity that comes with doing this right and effectively. So moving forward, to then contextualize that as our starting point, what we try to focus on as investors is try to understand what are the key levers of this, or put in a different way, what are the translation mechanisms in which we would see good human capital management practices come to fruition, right? So you have your revenue, your cost, your assets, and your liabilities. Traditionally, people would think as employees and the cost of employees as a liability. We see them as an asset, not only an asset, but an appreciating asset. So that would be part of intangible assets, right? Where we think about other things such as culture, talent, and then with fixed assets, it's coming from the perspective of more so strategic workforce planning. So when we think about these translation mechanisms in the form of human capital management, what we want to understand is this is quite a different starting point to what has been done elsewhere in this space. Where people have looked, for example, at standard setters and what's expected in terms of disclosures. A lot of investors focus on disclosures where companies in a qualitative sense talk about human capital management policies, programs, their employee turnover, and other quantitative metrics. But we're trying to kind of come at this from a different lens. We started from this perspective of, if this matters, we should see it in the leverage that companies are generating on their investment in people. And so what we then did was go to the academics, go to the HR industry, and said, okay, so well, how do HR practitioners in reality measure this? We didn't have to invent the metrics ourselves, is what I'm saying. We look at metrics that exist over here in the HR industry. We took the metrics that have been developed and honed and stress test, et cetera, in academia, and we said, well, let's see if this works in investing. And then let's see if it can generate some of these metrics, for example, returns on human capital investment as part of our analysis. And then let's see if we can integrate some of these metrics, for example, on that part of human capital, and let's see if we can integrate them into traditional definitions of company return on capital, as well as then can we articulate, well, in a company's value creation model, if we define creation financially as the returns on capital employed, the question is, what proportion of that return is being driven by balance sheets or physical assets or tangible assets and traditional physical assets? But then what proportion of the value creation is being driven by the intangibles and the investments in those people? Because through that lens, that directs us into how we engage with companies and basically understand, well, if a company is trading cheaply and has really strong human capital management practices, there is some long-term view that we can take on the overall prospects of that company over time. Whereas if we see companies that are trading quite expensive and have very weak human capital management practices, is it only a matter of time before that catches up to them, is essentially what we want to be able to understand by the end of the day. So what we also want to understand is, how much of that investment is invested in. So the whole concept of looking forward and understanding what are the skills gaps, which employees are best able to address those skill gaps, and are we investing in them in such a way that at some point they can be addressing those skills gaps that as a company will be necessary. So this is kind of the starting point in how we think about quantifying this and looking at traditional balance sheet metrics and just finding where those human capital levers exist. So what does human capital management look like practically? Is it in dollars? Is it in salaries? Is it benefits packages? Is it nice holiday perks? Is it something like teamwork or culture, strength and leadership and purpose and so on? We haven't been able to answer all of the questions on kind of some of those latter points. However, the collection of some of the softer skills is something that we're seeing quite interesting data and information is. Basically, some information is harder to dollarize, and other information we can kind of see what it means at the end of the day. And we're not always trying to dollarize them at the same time, but we've got to sort of this point so far where we've been able to articulate what portion of the investment in people really can be sort of considered a direct cash-based investment, how leverage on that investment drives return on capital, and then where are the residual, i.e. the collective sort of power of management and culture, management of trust, management of performance management processes, innovation being really important, and so on. And then where then that flows into excess returns on investment in people is where we then sort of stop in terms of research that we're shortly, we'll send this out to you hopefully as a follow-up to this. It's quite lengthy, but I think worth the read. And then with that, begin to ask questions of companies and how they can better drive that to extract higher returns going forward. And so it's really exciting. A number of conclusions that our research are really pointing to is that it's pretty material for investors. And so number one, companies that are better human capital managers create more value through the cycle. So when we think about the peak and the trough of the investment cycle, those that are outperforming are those that have better human capital management practices. That's gold to an investor. And that's really exciting because, one of the core tenets of sustainable investing is that, as I mentioned, more durable companies, more sustainable companies will hold on to their returns throughout the cycle more than others. And we look at that through the lens of climate change, the management of nature dependencies, and human rights issues that are getting more regulated. But human capital is obviously much more foundational to the company. So to see that kind of proven out in our research is quite positive. We've also, let's look at time. We've also found that a number of the quantitative human capital metrics that we have been developing are additive to the investor returns when we look at them in our back testing model as well, which I think is really important from the academics perspective. So, human capital return on investment, for example, has a high degree of incremental explanatory power than when we integrate that into a multi-factor quantitative framework, which you can see in the research, the broader piece that we'll send around. And so what we were really finding at the core of it is that markets tend to reward companies that have better human capital management practices, that are better human capital managers. And we looked at this across multiple industries, multiple time horizons, multiple regions where human capital and labor practices frankly differ. How you look at human capital practices in Japan are much different than how you look at them in the US. But despite that, the kind of information persists. I think when you look at some of the information that we've provided here, these are kind of the different quantitative factors that we're looking at, and some of these should not be new to some of you at all. So when we're thinking about the human capital cost factor, essentially, what is the cost of the employees net? When we're looking at human capital return on investment, it's really that costed, the return on that cost minus the money spent on investing in people. When we're thinking about employee economic added value, the purpose for this, as you see here, it's really focusing on the employees that are working at a given organization. And, we want to use this to really understand the total value of the investment and where that added value is coming from good human capital management practices. And so with all this in mind, we're bringing this information to the balance sheet and actually working with our investors in a way that with human capital before was much more of a qualitative exercise. And so now we're kind of making it more of an accounting exercise backed by fundamental research. I think that the final thing that I would say is that, we have found that it's really, really important when we think about the drivers of human capital returns that a company addresses human capital or addresses the management of their people holistically. And by that, I mean, because of the complexity of an organization, it's not really optimal to just focus on pay and nothing else. Because if you skew kind of your incentive structure, if you skew the way you manage your human capital asset one way at the expense of another, you create kind of an imbalance of the outcome. You create an imbalance of the incentive structure. And we see that actually, like companies that are not taking a holistic systems approach to managing the human capital assets do not fare well when we look at the research. So perhaps, they're not planning workforce capabilities effectively, or not perhaps incentivizing effectively through things like stock-based compensation, through salaries, benefits, et cetera, or not managing their cultural inclusion effectively. The companies that fall short on these elements, or any one of these elements, generally are appearing to be a little bit weaker in the outcomes that we look for as investors. We spoke in the beginning about demographic shifts, and AI kind of falls into this conversation now when we think about workforce productivity. So basically what we're focusing now, a lot of our research on AI is, as we think about human capital, people as an appreciating asset, how do we think about AI as an appreciating asset, given that proper focus on deploying human AI from the HR perspective is to generate productivity gains, is to then have employees focus on solving for those skill gaps that they see as most essential to the future productivity and growth of the business, and making sure that kind of there's an alignment in the implementation of one to ensure that from a human system standpoint, you can continue to move forward. And so you'll see more from us on that point. So I'll pause there. Happy to talk to you all more a bit throughout today, and if I pop in tomorrow. But otherwise, we'll make sure through Emma and team that we get you the full research report.